India's banking system liquidity fluctuates between the tight deficit and comfortable surpluses. Managed deeply, managed, uh, managed closely by the Reserve Bank of India. Short-term liquidity frequently respond to tax cut flows, currency demand, and forex interventions, while broader levels adjust with capital flow and the spending. Government spending. What is liquidity banking system? Liquidity in banking is a bank ability to access enough cash or quick assets to handle daily customer withdrawable and fund loans without losing money. It balances short term cash needs against long term, harder to sell assets like mortgage. What is the CRR and SLR? The current cash reserve ratio CRR is 4% and the statutory liquidity ratio is 8% of a bank net demand time liabilities NDTL as mandated by the Reserve Bank of India. Definition: the minimum percentage of total deposit commercial bank must keep and liquidity cash with the central bank, so RBI. What are the three types of liquidity? In general finance and economics, three primary types of liquidity are market liquidity, how easily assets trade on a market, accounting liquidity, how easily company pay short term debit with its assets, and funding liquidity, how easily bank or person get cash by borrowing. Assets trading, high volume. How does RBI manage banking liquidity? The Reserve Bank of India manage banking liquidity using policy corridor and core tools to control cash flow. It uses the liquidity adjustment facility, corridor, open market operators, and reserve ratio to inject or absorb funds and keep short-term interest rates stable. Liquidity adjustment faculty corridor, policy repo rate, marginal standing facility MSF, standing deposit SD. What bank is called mother bank? The Reserve Bank of India is commonly referred to as the mother of bank or banks of bank because it regulates, supervises, and controls all other commercial bank in country. RBI is called mother bank, controls currency, mother bank. Which assets has highest liquidity? Cash is the most liquid assets because it is already in its usable from, require no conversion process, loss no value in trade and can be spent instantly. Other higher liquidity assets, checking and saving account, money market funds, marketable separate. What are two measures of liquidity? The two basic measures of liquidity are the current ratio and the quick ratio, also known as liquid or acid test ratio. These market helps evaluate if company has enough short-term asset to pay off in short-term debits. Current ratio, meaning formula, goals. What is the liquidity of banks? In banking, liquidity is the ability of a bank to access enough cash or easily convertible assets to meet short-term obligations such as customer cash withdrawal, bill payment, and interbank loans without losing. Liquidity assets, liquidity assets, illiquidity assets, liquidity. What are the four liquidity ratio? The four primary liquidity ratio used to measure a company's short-term financial health and ability to pay debits are the current ratio, quick ratio, acid test, cash ratio, operating cash flow ratio. These metrics divide various levels of liquid assets by current abilities. Current ratio or quick ratio. How to identify liquidity? In financial and crypto trading, liquidity refers pools, resting depending orders, and clusters stop losses where large market participate can exceed to size. You can identify liquidity by locating obvious technical levels on a price chart where retail traders commonly place their stop, such as swing high, low, and equal high or lows. Mm, how to manage? Which bank? Which are the nationalized bank? Nationalized. India's 12 public sectors are nationalized bank, regulated Reserve Bank of India, following major government-led consolidations. These 12 institutions comprise the entire state-backed commercial banking network. State Bank of India, Punjab National Bank, Bank of Baroda, Canara Bank, Union Bank of India, Bank of India, India Bank, or billionaire. How do bank manage liquidity? Liquidity management in bank is the daily process of making sure bank has enough cash, safe assets to meet withdrawals from customer, payables and funds, loans and balances, keep enough safe cash hand with making profit by lending money.